My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make a little money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Apple won, Fed nothing. That's the score. It's all you need to know about today's trading, as Apple briefly regained its title as the largest company on Earth, rallying nearly 3% and helping propel the S&P and NASDAQ to new records. The Dow dipping 35 points, S&P jumped 0.85%, NASDAQ pole vaulted 1.53%. This despite the fact that the Federal Reserve kept rates unchanged at high levels and said they're going to stay high until we get evidence that inflation is more subdued. How did Apple stock and so many other big cap stocks rally in spite of the Fed? Because events have overrun pretty much everything all at once. First this morning, we got a consumer price index number that was very cool. Much different than we thought. It was a clarion call that inflation seems to have peaked. The actual core increase, 0.2%, was slightly better than the 0.3% we were expecting. If we get some more readings like this, the Fed will have what it takes to cut rates. So many prices fell. Airfares, motor vehicle insurance, new vehicles, communications, recreation, gasoline, eggs, uncooked poultry, including turkey, fish, ham, cheese, veggies, potatoes, avocados, carbonated drinks, milk. The CPI number simply didn't jive with the narrative that the Fed clearly brought in when it started its meeting yesterday. Before the CPI, members of the Open Market Committee seemed inclined to give us no rate cuts this year. But after the CPI, that seemed wrong, and the Fed's now on board with one rate cut by the end of the year, although that could change depending upon the data. Of course, this is just one inflation number that came out in the middle of the Fed meeting. So you can't have a hard line Tuesday and soft line Wednesday. That's difficult. Now, I thought Jay Powell walked the tightrope incredibly well today, basically saying if there are more good numbers like today, then the Fed indeed can cut. If there aren't, it doesn't have to. The economy is gradually cooling, he said. It's gradually slowing. It's no longer superheated. That's perfect. Fed policy says no transcripts of meetings will be released for 5 years. We get the minutes a lot sooner, but they're much less illuminating. So we'll have no idea who could have changed their mind in response to this number. No matter, this very meaningful CPI reading seems to have caught them totally by surprise. In that sense, the positive event completely overran the negative expectations, causing interest rates to plummet instantly. Which brings me back to the stock market. Because in the last few days, we've seen some good news about big tech that have caught investors by surprise, too. The timing, two incredibly bullish set of events happening at the same moment, produced breathtaking results, especially in the NASDAQ. As surprising as that positive CPI reading was, the back-to-back explosion of good news from Apple and then Oracle was perhaps even more shocking and exhilarating. Apple started it all announcing many different improvements to the next iPhone, the 16, incremental improvements. But when taken together, they amounted to a revolutionary new product that could possibly trigger, I don't know, 1 billion upgrades, given that the new iteration will have AI, and unless you have the 15 Pro or Pro Max, your old phone just can't take advantage of it. Apple stock had run into the Worldwide Developers Conference on Monday, but Wall Street and the press were initially quite negative on the new features. However, the public has more divisions than the analysts or the press, so the groundswell of support from the actual buyers of iPhones shocked Wall Street. Apple's now rallied a stunning 8% since this week began. Staggering. How about Oracle? All right, the big enterprise software play. All right, Oracle actually issued weaker sales and earnings numbers. The headlines look bad, but it has a cloud division. That's right. It has a huge, rapidly growing data center business, gigantic buildings that cater to the so-called hyperscalers. Hyperscalers like Microsoft's Azure, Google Cloud. Both of them have come in with gangbuster orders. Oracle has a backlog of almost $100 billion worth of demand. That's just incredible. And it confirms what the bulls have been saying all along, that generative AI is real, and it's spectacular. Wall Street was blown away, and Oracle rallied more than 13%. Of course, if there's that much demand for data centers, that means there's a tremendous demand for the wares of Microsoft and Google, or they wouldn't have bought into the Oracle data centers to begin with. Now, what goes into those data centers? Well, let me see. How about the NVIDIA chips? And that's what the pin action from Oracle took NVIDIA stock up more than 3.5%. Oh, another $100 billion in capitalization just added like that. That's extraordinary, especially given that NVIDIA just had a 10-for-1 split on Monday. My work on big splits like this one says the stocks tend to churn, to flop, to chop, and go nowhere for at least a bit, as individuals who own NVIDIA ring the register on 2 or 3 of their shares of the 10. But I think the overwhelmingly positive news from Apple and Oracle staunched the selling and then turned the stock straight up. Now, if you stay tuned, I'm going to give you a deeper analysis of my Apple stance, and I'm going to do some work on the NVIDIA chart. But non-spoiler alert, I continue to hold that you should own both stocks and not trade them. And I am grateful for all the well-wishing thank yous that both Jeff Marks, my partner in the CNBC Investing Club, and I have received for those 2 somewhat courageous stands. Tonight, we got still one more set of great tech numbers, this time from Broadcom. Haven't heard of them? AVGO? It's a $700 billion behemoth that makes equipment for, yes, indeed, the data centers, along with other parts of the tech chain. This company, a large holding for the Charitable Trust, is trading up gigantically after the bell. Now, once again, there'll be plenty of people who dismiss these moves as just tech going crazy. Oh, they're waiting. They're waiting for Procter & Gamble. Coca-Cola, that's got to go. JP Morgan's got to advance. All of them down. And they're harping again on the narrowness of the advance. I am tired of these people. Interest rates went down on the CPI numbers, and they stayed down when Jay Powell definitely announced the Fed's position. That triggered tremendous buying in what had recently become the moribund housing and home improvement group today. Next, home builders like D.R. Horton, Toll Brothers, Lennar, Scorched Tire, Home Depot, Lowe's, they burst forth. These are important companies, people, that many people feared would be choked into oblivion by the Fed's higher for longer stance. They'll do much better if it's higher for not quite as long. Oh, and just to be sure, it's no longer reasonable just to say, oh, it's just tech. That's because given the size of these behemoths, stocks like Microsoft, Apple, and NVIDIA, they can no longer be dismissed as narrow plays on a single industry as they become the market. I'm not engaged in circular reasoning here, people. I'm saying these companies and those that follow them are so large, so immense in proportion to the rest of the market that if you're waiting for the rally to broaden out before you join in, I literally think what you're doing is you're cutting off your nose to spite your face. So let me give you some bottom line advice here. The 2 most important forces in this market, the Fed and tech, both got shocked this week. I mean, shocked in a positive way. When that happens, you're going to make a lot of money as long as you're in the right stocks. If you aren't, though, or if you're still fighting this move, let's just say, like the legendary Jeff Probst from Survivor, ain't got nothing for you. How about we go to Deepin in Illinois? Deepin.
Hi, Jim. Chicago. I just wanted to hear your thoughts on Pfizer. It's a stock that's been beaten down, but has a low price to earnings ratio, considerable dividend yield, and has been making acquisitions like with
certainly. So Deepin, let's analyze the situation. 6% yield. Okay, with rates falling, we definitely want that. Low price earnings multiple. Why is that? Because it doesn't have a lot of high quality drugs right now, prospects. However, they did buy CGM, which I really like, and I think Dr. Borlich should be given a chance here. It had a big COVID overhang. In other words, I agree with you. I think you can own Pfizer here. Ian in Pennsylvania. Ian.
Hey, Dr. Cho. First time, long time. How's it hanging?
Chill man says fine. How about you?
Feeling bullish on life, my friend. Just like a well-diversified portfolio.
I like that
my
positive attitude
across various sectors and expecting great return.
All right, that sounds good. So, I like that.
I will cut straight to the chase. My position in Colson Cores is redder than your world-famous marinara sauce. Over the past couple months, it's down 25%. Can you please provide me some color as to why this stock seems to be so undervalued, and do you recommend buying, holding, or selling?
I am concerned. I think the company's very good. I like the fact that they fixed a lot of their growth, but you know what? In the last few months, the growth has slowed, and there's no doubt about that, and people have turned hard against anything alcohol. I am not going to recommend an alcohol stock, even though that my wife's in the alcohol business. I have no desire to recommend the stock. Why? Because people have turned on alcohol in this country and around the world, and there's no doubt about it that unless you're in very special formulations, ain't got nothing for you. All right, the Fed and the tech sector have gotten shocked in a positive way so far this week, and when that happens, you are going to make a lot of money if you're in the right stocks. Well, Mad Money tonight, I'm diving into how one drug maker's discipline is becoming the key to its turnaround. Then, is NVIDIA on track to hit a new milestone? I'm going off the charts to break down its post-stock split action. And later, I'm talking with PG&E's top brass on the heels of its investor day to hear what's next for the utility company. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.